Welcome, everyone. This is Brian Hartstein, Director of Corporate Development here at Bayntree Wealth Advisors, and I head up the 401k team that works with all of our 401k plans and participants in helping everyone with their financial planning, financial goals, and utilizing their 401k accounts to hopefully save for retirement as fast and as efficiently as possible. And boy, do we live in interesting times. I think for just about all of us, we are in an unprecedented area of what is going on in our country and throughout the world. And what's interesting to us is that this topic, which couldn't be more timely in terms of how to handle market volatility in your 401k account, was actually decided upon at the very beginning of the month. So that's actually before everything that we're seeing now went down, and we were going to do this topic anyway. So it was perfect timing, and for most of the people that we talk to on a daily basis, it is extremely important. So just to let you know again who your team is here at Bayntree. Again, myself, Brian Hartstein. Also with me today is Chris Roger and John Jangle, who are our financial advisors who work with all of our 401k plan participants with their questions and on helping them with their accounts. Then we also have Rena Blanco and Jessica Amaya. And once again, we are here to help you in any capacity that we can, whether it's general financial planning questions, help with risk tolerance, optimizing your investments, anything that has to do with your financial planning picture or your financial plan. That's what we're here for. There's no cost for any employee of a 401k plan that we help service and advise upon to access our services here. So we please stress that you can always reach out to us via email, via phone, or even stop into our office. Although in this heightened health emergency, we're not sure about stopping in the office in terms of having regular appointments. But again, we're here for you. So you just have to let us know how we can help you. So again, today, a very, very timely topic, and I know it's on the forefront of most people's minds, which is taking the emotion out of your investing, specifically in your 401k account, reducing the investing emotional extremes that you may be experiencing, and I think most people are experiencing, how to stay the course, dollar cost averaging, why that's important, and one of the most important things that we actually don't talk enough about, but is a very crucial factor in your planning, which is rebalancing your portfolio. So it's interesting. I remember being in college, a freshman in 1987 when Black Monday hit, and I've seen that. I've seen the recession of the early 90s, the capital long-term crisis of the late 90s, the explosion of the dot-com era in the early 2000s, the financial crisis of 2008, and now here we are today. And I'll say each time that we've seen these types of effects to the economy and to the social structure of the United States and the world, every time the factors seem to be different. But there are lessons that we have learned and that we employ here, and that most importantly, that you can use when you're doing your own financial planning and specifically your 401k planning, that hold true no matter what environment we're in. And that's what we're going to cover today. And again, we have a lot of experience in this area, but all of these lessons that we've learned can easily be applied by you and your loved ones to help you make the right decisions in sometimes very, very difficult circumstances. And that's what we're here to talk about today. So I'm going to turn it over to Chris. He's going to jump into how to take emotion out of your investing, and then we're going to go right through the webinar.
Okay, thank you, Brian. Hello, everybody. Again, my name's Chris Roger. I'm one of the financial advisors here on the Bayntree team. And like Brian said, very interesting times that we're in today, and couldn't be more timely with reviewing market volatility and what's best practice. Everybody's plan is going to be a little different, but the name of the game and what most investors try to do is buy low and sell high. But often we see investors do the exact opposite. And this really comes down to understanding what type of investor you are, meaning, are you looking to retire 1 to 5 years? Are you looking to retire tomorrow? Are you looking to be invested for 5 to 10 years or 10 years or more? And everybody's plan is going to be a little bit different. So this is just really an overview to go over some mistakes and maybe some errors that investors make and how you can try to avoid them. And it all really comes down to stressing your financial plan and understanding, do you have the right pieces in place to withstand these types of market environments and this type of volatility? So what you can see here is really the emotional roller coaster, and that's really been on display for the last 2 or 3 weeks here. And what we've seen over the last couple of years, if you remember 2017, the market had a strong year. Volatility was at all-time lows, meaning there wasn't really a lot of big swings to the downside. And then if you recall 2018, the equity markets lost approximately 20% of their value in the fourth quarter of 2018. And then what did we see last year, 2019? The markets ran up 25+%. So, and now we're seeing right now the volatility recently give back a lot of the 2019 gains. So you can see this kind of roller coaster ride that we have here. And for all of you that are still adding to your 401k plan, think about last year when the market was at these all-time highs. You were adding to the 401k plan at these times at all-time highs. And then what's happening now is investors are feeling, oh, I'm going to put more into the market. I'm going to put more into stocks. And again, they're doing that and they're getting more aggressive while the market is at all-time highs. Then what happens is we see this volatility here. And now what we're seeing is a lot of investors reacting emotionally and not sticking with their game plan. And now we're, I don't know exactly what part of this curve that we're in right now. We don't know what the ripple effect will be of this virus, but right now investors are reacting emotionally and getting out and going more conservative. So one of the things that you want to be able to do during this time frame is stay disciplined with your investment plan. And what you want to continue to do is continue to add to your 401k plan, because what we've learned in the past through the different past market volatility and past crashes is the investors that stay the course end up ending out well in the long term, making out well in the long term. So understanding this type of curve and understanding where we are today, the most important thing you can do is stay disciplined with your plan, and then you're going to thank yourself long term for doing so. So kind of looking at this continued curve, okay, and the volatility that we're seeing here, and just kind of mirroring and echoing what I just spoke about, right? The market's good. We all know it's going to ride high, it's going to ride low, and this is really where we stress diversification and understanding the risk level that you have in your 401k, and understanding you're going to have some investments that have more risk, that may see some more volatility during times like this. But then some of you may want to add some investments that are going to be a little bit more safe or conservative during these types of times. So this is where, if you have questions on diversification and should I make any changes, or should I be adding more to my 401k plan at this time, those are the kind of things that we can help you and guide you through this type of volatility.
Exactly, Chris. Two of our favorite questions to ask people when they call us and say, hey, should I move from stocks to bonds, or should I change my allocation and become more conservative? And we always like to say, has your objectives changed? Has your time horizon changed? And has your risk tolerance changed? Now, risk tolerance is key, because many times people think they can take more risk in a bull market because things are doing well and they feel better. But when we're in a down market, maybe their risk tolerance isn't as high as they thought. But if your risk tolerance really hasn't changed and your objectives and time horizon hasn't changed, then really your structure shouldn't change. If anything, you just need to keep staying the course, and over time, the fact that your time horizon hasn't changed will benefit you in the long run.
John Jangle here. So I'm going to kind of elaborate on some of those planning points that Brian and Chris just discussed. So first and foremost, staying disciplined to a plan requires that you have a plan. So if you don't have anything set up, it's really important to evaluate where you are and understand if that plan is still appropriate for what you're trying to accomplish. Here in this slide, we're looking at kind of a hypothetical difference in returns, and this goes back to staying the course. So for instance, if you don't have a plan and you've just been investing in equities because the market has been high and you're not really sure of your own personal time horizon and purpose for investing, then you could be surprised by a lot of this volatility. Now, for instance, if you start seeing this volatility and you are, getting emotional in terms of, I want to get out of those positions, we understand from history that the average investor is pretty bad at timing the market. So for instance, if you're buying in at these high points, or we're buying in at these high points, and then you become kind of freaked out by the current market climate and you decide to shift from those equity types of investments because, again, you don't have a plan, then you're likely selling out and not giving yourself the opportunity to have exposure to those same assets that are going to inevitably come back over time. So what we want to avoid is selling out from what your personal plan is and getting into assets that aren't going to give you that exposure to make up those losses over time. Again, understanding your own personal time horizon, what the purpose for these funds are long-term will then help inform how you are allocated at a certain point in time. Now, if somebody is closer to retirement, ideally they would have had a proper asset allocation prior to this new market environment coming into place. So that's why it's important, if you don't know where to start, or if you haven't started, or you're kind of just doing things on the fly, have a conversation with our team so we can really identify what the key planning points for you are. Now, one area of planning that you're all kind of doing automatically anyway, if you are contributing to the 401k plan, is dollar cost averaging, and it's an important tool that you can utilize to take advantage of a couple things. So essentially, you are purchasing the same asset. If you have an asset allocation in your 401k, you're purchasing those same assets at different points in time at different price points. This means that you're going to be buying that asset when it's expensive, at a premium, or when it's at a discount, overall averaging out that cost to you as the investor to own that asset. That also gives you different starting points to kind of smooth out some of that volatility and that overall risk. So it's a really important tool that is, like I said, automatically utilized if you're contributing on a regular basis to your 401k plan and not making a lot of changes to that plan, assuming you've set up that plan appropriately when you start contributing. But what it really does is eliminates a lot of variation in cost for you as the individual investor, and can average out those returns over a long period of time for your benefit.
Yeah, John, to me, and I think to everyone here, this is one of the most important pieces of a 401k plan, and why volatility, like the volatility that we're seeing today, is your friend and is actually helping you within your 401k account. Now, for outside accounts and other investments, that's a little bit different. Again, we're happy to talk with you about those as well. But specifically inside your 401k, dollar cost averaging is the reason volatility helps you. Like John said, if you're going to retire in 15 years, you don't want the market to go straight up from the day you start working to the end of your working life. You want it to move around. You want to buy those shares of equity cheaper at different points, because over time, you're going to end up with more money in your 401k account as long as you're consistent in your buying process and in your allocations. Don't make emotional decisions, and you dollar cost average on every pay period. So again, it's not complicated, but it's in the simplicity of how this volatility works for you that is really the key to growing your 401k account. We can't stress that enough. So one kind of overlooked area that we also like to touch upon here as planners, in fact, we probably don't talk about it enough, but we should, and that's one of the reasons why we're talking about it today, is rebalancing. And rebalancing can take several different forms or shapes. You could rebalance on a time period, where maybe you're taking your investments, and as some parts of it grow and some parts of it decline, you rebalance every quarter or every year. And for some, you can rebalance when certain percentages go out of whack. So if you had a 65% allocation to stocks and equities and that went up to 70, you might automatically rebalance once it hits 70. So it depends on how you rebalance. Most 401k platforms that we work with and our participants are utilizing rebalance on a time basis, meaning you can set in your account to rebalance either quarterly or on an annual basis. And we would like to submit to you that is extremely important that when you set up and you work with your account, or we can even show you how to do it, that you choose to rebalance. Whether it's quarterly, whether it's annually, it is extremely important, and you're seeing the effect of that now. So for example, when the market tops out, your equity allocation, if you don't rebalance, is going to be most likely higher than what you set it at. So again, if we go back to March of 2000, and somebody might have had an equity allocation of 60 to 65% because of the run-up in the stocks in the dot-com era, you might be at 74%. And if you didn't rebalance when those markets got hit, a bigger portion of your portfolio went down. If you were consistently rebalancing back to the original percentages, you would have been taking money from your equities, probably moving into safer assets. And when the safer assets started going in value, you would have more there. And when you see the market bottoms, let's go to February of 2003, an equity allocation that might have been 50% could have been down to 45 or perhaps even lower. So rebalancing, taking monies from areas you've done well in the past and moving them to areas which haven't done well will help you so much during times like these. And I know it's counterintuitive. People say, well, why would I want to move money from my equities? They've been doing really, really well. It's hard to do it. That's why if you automate the process and set it within the platform, it will do the work for you. You can set it and forget it. And I guarantee you, the one thing I will guarantee you is it should be very beneficial for you 5, 10, 15 years down the road. So that's one of the reasons we love to talk about rebalancing. And again, if you have any questions regarding this, please feel free to call us. So again, hopefully some of these tools we just told you about, taking the emotion out of investing, understanding dollar cost averaging, using rebalancing, making sure your risk tolerance is still the proper risk that you want to take in your account. We can't stress that enough. And making sure your financial goals and objectives are still the same. We can help you either do a quick checkup on those or help you if those things are changing for you based on maybe your job now or different things that you're dealing with, but we're here for you. And again, we urge you in some, not to make knee-jerk reactions to your 401k, but if you're going to take action, talk to us first. You can always email us at our email addresses. You can see our contact information here. You can call us. We are here. We're working, whether we will be in the office or working remote, we will be here to help you. And that's what we're here for, is to make sure that you can use your 401k plan as efficiently as possible. So our most important thing for you is to stay healthy, stay safe. And again, remember that we're here for you. And hopefully we'll be speaking soon and we can make sure that your planning is exactly what you need it to be. Thanks and take care.